Yo, what up, everybody? This is your boy Sharaf again. Welcome back to another episode of the Disruptive Investing channel. In today's episode, we'll be taking a closer look at a disruptive e commerce company, which you all may already know by now. And yes, I'm talking about Shopify. We will explore whether Shopify's recent steep decline in prices is justified and whether it can weather a possible North American or even worldwide recession. During the pandemic highs, Shopify was a retail darling, experiencing an incredible 400% increase in valuation between 2019 and 2021. However, as we are all aware, the stock has taken an equally spectacular hit in recent months and now trading at around $43 at the time of the filming of the video. So now that this pandemic unicorn is coming back to reality, does that mean the days of its unprecedented growth are finally over? Is the stock finally at an attractive valuation, or is there more room for further decline and more pain for the bag holders? These are some of the questions that we will be answering in this video, so sit back, grab a coffee, relax, and enjoy the rest of the video. But before we begin, here's a quick plug to please like and subscribe this channel. Your support serves as a source of encouragement for me to keep making more and more videos. And lastly, the typical financial YouTuber disclaimer that I'm not a financial advisor, so please use this video as a guide to do your own due diligence and your own research before investing in any of the companies. Well, I don't want to get too much into the details about the Shopify's business, but I do want to compare it to Amazon's e-commerce business. Amazon is a well-known company that is closely intertwined with the lives of the North American consumers. So it would be beneficial for the audience and investor to understand the similarities and the differences between the two businesses in order to better grasp Shopify's business model. The most obvious difference between the two businesses is that unlike Amazon, Shopify does not sell directly to consumers. Instead, Shopify offers e-commerce tools that enables entrepreneurs and merchants to set up their own e-commerce stores on Shopify's platform. In turn, Shopify makes money from the merchants' subscriber fees and transaction fees. So at this point, the natural question to ask as an investor is why merchants would use Shopify when they have a behemoth in another e-commerce giant in Amazon, which offers access to its 310 million active users. The answer to this question lies in two major benefits of using Shopify or Amazon for merchants. The first benefit is to stand out. See, Amazon's biggest strength is that it pools demands and brings in what is possibly the largest customer base looking to shop at one place. However, the problem is that the businesses that sell on Amazon makes it a commodity and does not help them stand out. This is where Shopify shines, in the sense that Shopify allows businesses to plan and customize their own stores, providing them with the opportunity to stand out amongst the rest. And the second benefit for merchants using Shopify is its higher margins for them. For Shopify, the cost of discovering a product or bringing a customer to the website and converting them to buy a product, known as the cost of customer acquisition, will likely be higher than Amazon when the store is initially set up. However, since Amazon charges 20 to 30% of the seller's profit margin, in the longer run, Shopify provides much better margin to sellers compared to Amazon. Therefore, the point of this comparison is to illustrate and put into perspective the fact that even though Amazon is a much bigger company by a very big margin, Shopify still offers an e-commerce service that is different enough to help it stand out and compete with Amazon. In this section, we will be looking at the financial numbers for Shopify. Although this video is focused on Shopify, I have decided to present the financial ratios in comparison to Amazon. This helps to provide some perspective and a relative sense of valuation for Shopify. Presenting the Shopify numbers in comparative term with another company is beneficial. For example, Shopify's stock has fallen significantly over the past year. Without any context, the stock would seem extremely cheap. However, when presenting in contrast to Amazon, you can see right away that in terms of sales and revenue, Shopify is still comparatively more expensive than Amazon, with a PS ratio of 10.16 versus Amazon's PS ratio of only 1.95. The story is the same for its earning, where the trailing and forward PE ratio for Shopify is much worse than Amazon, even after taking into account the massive decline in its stock price. Another interesting observation that can be made from these graphs is that Shopify's PE ratio has actually gone up even as its stock price has been hammered. This anomaly can be explained by declining profits at Shopify and future guidance of lower profits. This tells us that Shopify's impressive performance during the pandemic was more of an outlier than a norm, helped by favorable tailwinds such as big shift to online shopping. Therefore, it is not fair to expect the same level of financial performance post-pandemic, and that is reflected in its stock price decline. In fact, the decline in earnings is persistent, as evident by the forward PE ratio of almost 1400, which is clear indication that the stock is still very, very overvalued. The stock is also overvalued when we look at it from sales and revenues perspective alone. The PS ratio for Shopify is currently at 10.16, which is on the higher side when compared to its peers with similar business model. In fact, we can see in this chart that the PS ratio for Shopify is highest among its peers, which is definitely not a good indicator for its valuation. If you take a closer look at the earnings report, we can see some silver linings. In Shopify's latest earning report, they beat their earning by 8 cents per share, which represents an upside of almost 500%. The consensus was that Shopify would make a loss of 1 cent per share this quarter, but they ended up actually making a profit of 7 cents per share in the last quarter. Additionally, they beat the expected revenue this quarter to post a quarterly revenue of 1.73 billion US dollars compared to the expected number of 1.65 billion US dollars. However, this positive news is tempered by the fact that the projected estimates for earning in the next quarter show a drop to a loss of 5 cents per share, which is definitely not a good sign. This is the news that caused a drastic drop in the stock price right on the day of the earnings release. Let's move on to further analyze the income statement of Shopify in greater detail. As we have stated before, Shopify saw a positive increase in revenue of over 26% in the last year. However, we also noticed that the operating expenses grew at a staggering 45% from around 680 million USD to almost 987 million USD. As a result, their income from operation from last year turned into a loss from operation by almost 188 million USD. This goes on to show that the growth at Shopify is coming at a really high price. As investors, this is not something we want to see. Moving on to the balance sheet of the company, another concerning factor I noticed that their current assets, which include liquid assets such as cash on hand, market securities, and other receivable, decreased considerably from 8.5 billion last year to around 6 billion this year. Even though the company's asset base is large enough to cover its liability, making for a very robust balance sheet, shareholders may not want the company to burn through its liquid asset at an annual rate of almost 30%, which we saw in the last quarter. This becomes even more concerning when considering the future outlook, and it may make investors wonder if the company will continue to bleed money by drawing down on their current assets. Lastly, looking at Shopify's cash flow statement, we see a glimmer of hope in the fact that the company generated positive cash flow this quarter, with the free cash flow of almost 250 million USD, compared to the negative cash flow of almost 228 million USD in the previous quarter. However, on the yearly trailing 12-month basis, the company still has a negative cash flow. Nevertheless, there is a hope that this company can turn things around and generate positive cash flow in coming quarters. If you're still a fan of Shopify's business and are looking for some positive news to hold on to, you may find some solace in the fact that the company is expected to continue its growth well into the future. Its projected revenues for the end of the 2025 are expected to reach around 11.23 billion USD, up from the current revenue of 5.6 billion USD in 2022, representing an annual average growth rate of almost 33%, which is still a very significant growth number. However, even in these projections, you can see Shopify is not expected to become profitable by the end of 2025. This presents a significant challenge for the company to turn itself into profitable even in the face of continued growth. So, in conclusion, I will say that although Shopify is a relatively strong company with a decent business model, it's still unprofitable and less than exciting outlook for the future cannot justify its high valuation. While it is expected to continue growing well into the future, this needs to be combined with a significant cost-cutting measures before the stock can make any sense as an investment. Therefore, at this point, I cannot recommend the stock at its current valuation, and I am personally not invested in this company. In fact, there's another e-commerce giant, which we already talked about, Amazon, whose stock also took a big hit, but that stock presents a much better value proposition. If I had to pick an e-commerce stock, Amazon would be a clear winner by a huge margin. If you guys want me to make a video on Amazon or do a comparative analysis on Amazon, please like this video and let me know in the comment section. If there's significant interest, I would be more than willing to look into it and make a video on Amazon. Until then, take care. I'll see you in my next video. Thanks again for joining me in another video of Disruptive Investing channel. Peace out. Thank you very much.